All right, guys, we're going to get started now. But yeah, that's better. First of all, I just want to thank everybody for joining us today. And more than that, I want to thank everybody for being part of. Thank you for being part of Boa from the very beginning. This year has obviously been kind of like our beta test year, and the platform has already come so far in that time, and that's all because of your support and involvement. And many of you had lots of conversations with me to help us. And anyway, myself and Mark just wanted to thank you for that. As we all know, business is not easy. In fact, it's very hard, and it's even harder when you're at it alone. And that's why Boa as a platform is so important. Right? We just want to make it easier for people like us to grow our network and build relationships that make us stronger, for business owners to support business owners. And that's what today's all about. And there's very few people that support business owners, SMEs, more than Mark Bouris. So Mark, thank you so much for your time today. Guys, you can expect, we're going to light the, what's it called? We're going to set the rocket free on Boa next year. So expect a huge year next year. But today we're going to focus on a few topics with Mark. So today's event will be short. It's 45 minutes. It's broken in two parts. 30 minutes me interviewing Mark on three topics, including the economy, the property market, and kind of the business environment. So what businesses should be doing at this time. And then we've got 15 minutes of Q&A. As you think of questions, or if you think of questions throughout the conversation, please just type them in the chat, and the Boa team will send me the questions so I can ask them, and obviously we'll get through as many of them as we can. If you could make the questions as kind of like broadly relevant to business as possible, that would also be helpful. That's all I have to say. Mark, do you have anything you want to throw in before we kick off?
Not really, Dan, but I reiterate all the things that you just said earlier. I mean, we start off with a great plan at Boa, and like every business, you encounter not challenges, but you encounter sort of things that slip you down through a back alley and back up the side street, and you've got to find your way back to the main road all the time. That's a typical process of business, and it's not underestimating the issues in business, but it is, as usual, getting blindsided by things you never expect, and that's just normal. You always get things that you don't expect, and Boa has been a bloody good example of that. But again, the beta testing period has been invaluable in terms of feedback that you guys and the team been getting, and that's allowed Dan and his team to make sure they respond, or try and respond where possible, to those suggestions and or challenges that you're throwing up to us. But I think it's been overall, I think it's been a pretty good year for us in terms of what we've achieved. That's my point of view. And I think 2024 is going to be a really big year for us. So I'm looking forward to it. I don't want 2023 to finish. I'm not in a hurry for 2023 to finish. I'm like, don't get me wrong, I'm not wishing 2024 upon us, but I am looking forward to 2024 as well.
Awesome. Well, let's start. We're going to start on the economy first. Like, I know no one has a crystal ball, but I'd love to hear your opinion on the current economy and what you're expecting to happen over the next 12 months.
Okay, it's very interesting, the current economy. So I think we have parallel economies right now going on. So we have that part of the economy that is heavily indebted and is interest rate dependent, and as a result of all the rate rises, is sadly being badly affected by those interest rate rises. So there's that part of the economy. Now, that part of the economy is 1/3 of the economy. Now, I'm talking about in terms of, if you look at individuals and people, in terms of people, like individual people. So 1/3 of the economy has a mortgage, but of that 1/3 of the economy that has a mortgage, 2/3 of those, of that 1/3, have a mortgage which is more than 7 years of age, which means those people sit in that 2/3 of the economy aren't as affected as the other 1/3 of the 1/3. Now, what I mean by that is 1/3 of the mortgage economy, 1/3 of those people who have a mortgage, took their mortgage out over the last three and a half years. Those people would have borrowed money at a really low rate, and as a result of that, they're paying much higher repayments per month, and therefore a greater percentage of their take-home pay is now being dedicated to mortgages. And as a result of that, they're sort of a bit poor, and they are the people who are suffering a bit, and also very anxious because they don't know how long this is going to go on for. The other 2/3 of the mortgage belt are people who borrowed their money a long time ago. They've enjoyed 7 years of really low interest rates, and they kept repaying their mortgage at their old schedule, so they're ahead of their mortgage. They got a bit of redraw, or they got offset accounts, so they've parked some cash. They got some money to see them through the tough period, and those people are still at their reasonably well spending, and they might not be taking a trip off to Athens or New York for Christmas, but at the same time they're still traveling, they're still going to the Gold Coast, they're still having a holiday. They just pull their spending back a little bit. And then there's the other 2/3 of the total economy in terms of people. That is the 1/3 of people who don't have a mortgage, who rent. They are doing it tough because in actual fact, that whole economy, that whole 1/3 of the economy is doing very tough because they all rent. They don't have, they don't have long-term leases where they're locked in for 20 years at a certain rental payment. They're all getting renewed rents. They're all moving from place to place. They're doing it very tough. And that tends to be the lower age cohort of people in the country. And the final third is that third of the economy who had a mortgage and have paid the mortgage off, and or they're retired, they got money in the bank, or they got the super, and they've never had it so good because they're earning 5% per annum interest rates where they used to earn 1% per annum. They're able to, they got used to adjusting their lives back when interest rates were low, so they were very good at spending not as much money, especially retirees. Now they're earning so much money that they've never seen this sort of interest rate before. They're adjusting their life up, so they're starting to spend more money, and they're the sorts of people who are affecting inflation. So when you look at how come inflation's been so stubborn, it's because of the factors that I just showed you. 1/3 of the mortgage belt aren't doing it too bad. 1/3 of the country is doing it tough. They're in the rental period, in the rental cohort. And the other 1/3 of the economy, in terms of numbers of people, they've never had it so good. So they're spending because they were doing it tough during the low interest rate period. So they're enjoying themselves. So Dan, we have this parallel economy, which is creating these confused data sets, which keep coming out from the Reserve Bank and the Australian Bureau of Statistics. How is it house prices continue to go up in certain places? How is it that notwithstanding these 13 interest rate rises, that all of a sudden that we still are having a stubborn inflation number, etc. And by the way, this is not just specialised to Australia. This is around the world, particularly in America. Exactly the same stuff's happening in the US. So the state of the economy relative to those business owners now, if I just go back to the business owners, which, by the way, are a very big percentage of the economy in terms of employment numbers, 70% in fact. Those people who rely on that 1/3 of the economy that's doing really, really tough, those businesses are going to suffer. The other business owners who have as their audience or their customer base the good part of the economy, who are selling to retirees, etc., or people who don't have mortgages, they're doing pretty good. So that tells us the reason why when we do look at the business confidence surveys, they are very positive. They're very positive. In fact, generally speaking, business owners are expecting to invest more money into the business. When you go look at that side of the economy, which is the consumer confidence, it's very, very poor. So, and I've never seen this before where we have such dichotomies. So, the reason is the reason I just gave you. The consumer part of the economy, which is which is made up of 1/3 of people who rent and 1/3 of the mortgage belt, which makes up quite a big percentage. That's 2/6. Those people, or whatever it is, a bigger number than that, those people actually by number are consumers who lack confidence, who don't feel very good about the economy. So that is my way of trying to explain the sort of parallel economies, the dichotomy that currently exists. And if you then ask me, well, how long is this all going to last? Well, I think if we get one more interest rate rise in December, which is big chance because the Reserve Bank governor, she's actually signaled that in the last couple of days, which is what they do. They tend to signal these things first. That will sort of really be a bit of a crush on us. And I guess the Black Friday sales and the numbers that come out of that will be a bit of an indication of where we're going.
Okay. And so like, I get the feeling like it's almost like a confused feeling. And like what you're describing kind of makes sense to why I'm always feeling confused. Like, I don't know, is the economy going to collapse? Is it going to keep going? And like as a business owner and as someone that literally just talks to business owners all day, like I feel a lot of people feel that. Are you personally concerned that we may fall into a recession? And if that were the case, how does Australia normally do in recessions?
Australia does, relatively speaking, around the world, compared to the rest of the countries of the world, does quite well in recessions. So just so we could be clear on this, so the only thing that will turn us into a recession, which, by the way, I got a feeling the Reserve Bank doesn't mind it if we have one. So therefore, they're not discouraged into adding another interest rate rise in December if they run the risk of putting us into recession. Because their view of the world, which is my view of the world too, their view of the world is a recession isn't really that bad for us because the current style of recession. So normally a recession means lots of people lose their jobs. And, you get 6% unemployment, for example, in a recession. That's a bad recession. If we get a technical recession here in Australia, we might get 4.5% unemployment. And in fact, the Reserve Bank wants to see 4.5% unemployment. They've already said it. Right now, we're at 3.6% unemployment. So, but at 4.5% unemployment, that's not too bad because actually that's if you look at our long-term run rate of unemployment, that's a very good unemployment number. That means another 146,000 people will lose a job out of the total population of employed people of about 11.5 million. So that's not too bad as a percentage, but it is another 1% of the economy is going to lose their jobs. But for a short period, Dan. So like it'll only be for the recession period because once you have a recession, once people start losing their jobs, those people who sit in the 1/3 of the economy who have never seen interest rates so high and are really enjoying themselves, the ones I just explained to you, they're going to start to tighten their belts up. They go, oh, hang on a minute, we've got a recession, so we better stop spending. And as a result, that inflation should come under control and the Reserve Bank's going to feel much better. And one of the things that happens when inflation does come under control and gross domestic product starts to drop, the Reserve Bank puts interest rates down. So that in itself stops the people like the retirees from feeling so wealthy because all of a sudden they're not earning as much money as they did on deposit. And that actually, but it also, on the other hand, helps those people in the mortgage belt because they're paying less per month. Then everybody starts to get a bit more confident. And generally speaking, the gap between a tough period, in other words, a down period in the economy, is somewhere between, historically in Australia, between 9 and 15 months from the commencement of the interest rate rise period. So our interest rate rise period started in April last year. We're already 15 months past that. So you would expect we have had we are extraordinarily different compared to normal periods of 9 to 15 months. So I expect the tough period to last maybe another year before interest rates start to drop. As I said, historically, it's between 9 and 15 months, but I think we have had such an extraordinary period before this that I expect to add on to the historical records of 9 and 15 months another year. So I say somewhere between now and this time next year, we'll start to see interest rates drop and we'll start to see things, let's call it normalize. In other words, and they're not going to drop by much. They might be dropped by 2 rate reductions, 75 basis points. Is all it will be. But that's all it takes to bring confidence back into the system and to normalise our lives. So by that time, we've all adjusted.
They won't drop to where they were prior. That's not
no way. There's just absolutely no chance. And I tell you why. Because they were interest rates, a mortgage rate was about 2.5%, that variable rate. It's now 6.5%. And the 2.5% was off the Reserve Bank rate, which was 0.1%. At 0.1%, that's absolutely the most emergency low rate we've ever had in our history. And that was all because of COVID. because that was a reason to press the emergency button, because everybody thought that COVID was going to be something we've never seen before. They didn't know what it was what it was going to look like for the future. So they just dropped the rates down to something ridiculous as an emergency rate, just like the emergency spending by the government at the same time, and all the emergency measures and policies that came out. But it turned out to be COVID wasn't that bad, actual fact. So, I mean, not in a health sense, but in an economic sense. So they need to give themselves headroom down. Like if there's a war, if there's a world recession or something really bad goes wrong, 0.1% is very dangerous for the Reserve Bank. There's no headroom for them to do things, to make adjustments. So they're going to push the official rate. They would like, right now the official rate's 4.35, but they would like it somewhere between 3 and 4%. Because that gives them headroom to do something if they need to do something. In order to get back to the rates, the borrowing rates that we used to be at, we have to get the official rate back to 0.1%. There's no headroom in 0.1%, none whatsoever. So they built headroom now, and they're going to work out how they need to bring it back. And normalization, I'm talking about normalization in an official rate and also the retail rate, but the official rate normalized will be between 3 and 4%. And let me just explain one thing economically about that. When the Reserve Bank's looking at where the sweet spot is for their official rate, they like to have this concept of what they call net zero, and it's got nothing to do with carbon dioxide emissions. Net zero interest rate, net zero official interest rate, is when you take what the official rate is, the Reserve Bank rate is, let's say it's right now 4.35, and you subtract from that inflation. Let's say inflation is 4.352. They like to see inflation effectively equivalent to what the official cash rate is. And when you net them off together, it's zero or something close to zero. They don't like to see it less than zero. A little bit more than zero is okay. 1% or 0.5% is okay. But that's their territory. So you will see the official rate, which is where we are right now, stay where it is until inflation gets down to about 4.35%, like on a sustainable basis, not just 1 month or whatever, like a proper year's reading of 4.35%. If inflation starts to drop to 3.5%, expect the reserve official rate to start to follow it down. So until we get to that period where we have a sustainable 3.5% inflation rate, you won't see the official interest rate drop. But I expect the official interest rate to follow the sustainable inflation rate. Now, I don't reckon they're going to get down to 2 to 3%, which is where they keep talking about. Maybe 2025, 2026 is possible. But I expect to see interest rates start to drop, the official rate start to drop, once we start to see a sustainable 3.5% annualized inflation.
Okay, and so with this in mind, that then really over the next year it might be quite a tough time for business, or certain businesses, particularly the ones that are serving markets, the demographics that are mostly affected by these interest rates and things. What would be your mindset as a business owner that you would share with others? And how you're looking at your business, how would you be preparing for the next 12 months? Or, how do you see businesses should act over the next 12 months?
Well, the first thing is you've got to make sure you look after those people who are currently your customer, whether they're a subscriber or whether they're someone who you serve every day. Because if you serve everyone every day or someone every week, if you're a plumber or whatever the case may be, or you're running a coffee shop for that matter, they're still your customer base and you've got to retain them. So and the only way you can retain them is their experience with whatever it is they're buying or they're buying from you. The price they pay, you've got to make sure they feel as though they're getting good value. So you've got to turn it from being a discretionary spend to pretty much a non-discretionary spend. In other words, something I've got to spend my money on. Now, most people say, oh, yeah, but they don't need to buy 3 coffees. Well, if the experience, they can buy 2, so they might drop back. Well, if I'm trying to keep you buying 3 coffees, in other words, I want to keep you subscribing to buying my 3 coffees. Subscription, it's still a subscription. It's just not happening by, giving me your credit card and I just hit you up every month. It's still subscription. You should still turn up and still buy my 3 coffees. If I want to keep you in the 3 coffees instead of dropping back to 2 coffees, to make a really simple example, I've got to make the experience that you get from the 3 coffees, particularly the 3rd coffee, something that you feel as though you can't do without. So what it is it becomes about not a transaction anymore. It now becomes about the experience. Before, during COVID and other periods, especially leading up to COVID, we got spoiled. It was like money was manna from heaven. Like we didn't have to try that hard to get people to buy 3 coffees because people were exuberant and were indulgent. We're moving at, particularly if you're in that category of people who are being affected by the mortgage interest rates, we're moving away from, and this is what the Reserve Bank's trying to do, because to be frank with you, inflation is a result of indulgent behavior. That is being prepared to spend any amount of money for whatever it is I want. So the way I change your behavior is I change what you consider to be an indulgence, as opposed to what is something that I must have. So you've got to turn, if you're a business owner, you've got to turn your product or service into the must-have category. Yeah. So if I want you to be in if I want to be in your must-have category, I've got to make that experience something you feel as though you can't do without. So I've got to feed your dopamine and your serotonin as much as I possibly can.
So in terms of then your clients, retention is the key word, and looking at the experience, looking at the price, perhaps even looking at the way you frame your product or its purpose. It could be all things towards retention. What about towards you as the owner? Would you be like spending? Would you be starting new projects? Would you be withdrawing new projects? Would you be hiring? Where's your head at?
Well, I think if you've got enough capital, and I think capital is the key here. If you've got enough capital to spend, then given that I think that this dip will only last a year, then I think that you should be preparing for what's going to happen next year. So don't leave yourself short. So one of my own businesses, where we just delisted our business with a view to putting ourselves in a position to make acquisitions, because my industry has peeled back quite a bit because people can't borrow as much money and there's a lot less people borrowing for all the obvious reasons. But I know that's going to kick off again late next year. And therefore, my business, I've put my business in a position where we're readying ourselves for 2024 to buy other businesses and or merge with other businesses to give me greater scale, which means I've got to spend money. And lucky, we've got capital to do that. So I think that if you've got the capital or you have an opportunity to get capital into your business, you should be looking at how am I going to take advantage of what's going to happen in late 2024. And it's not me making these predictions. This is money markets making these predictions. I'm just telling you what money markets are saying. Money markets are predicting a turn of events in terms of the difficulty that mortgage holders have. Right now, those difficulties would turn towards the end of next year. So if that is the case, then if you're in the environment whereby you are able to take advantage of that, then you've got to spend some money. You've got to invest some money now if you are in that position. So I took this view at the beginning of this calendar year. So in my business, I planned this delisting from January. It took me this long. I actually the stock went off the ASX literally yesterday was the last day, and it took me every day of this calendar year to get this into this position. So I've invested a lot of money because it was quite expensive exercise to do, a lot of hassle, a lot of drama, a lot of time, a lot of people involved, a lot of ups and downs, upset a lot of people. But this is for the betterment, from my point of view, for the betterment of our business and for us to be able to take advantage of the marketplace, which is sort of to answer your question, I therefore wholly endorse. If you're in a position to be in a better space in terms of your customers and your business this time next year, if things turn around, which is what the money markets are predicting, then if you're also in that luxurious position to be able to spend some money to improve your ability to have greater capacity, then do so. Now's a good time to do it.
I think there's a good lesson there in terms of, you have to, as the owner, always make the decision for what's best for your business, even if that doesn't make everybody happy. Your responsibility is the success of your business and the people that the business impacts, and therefore you need to make those tough decisions.
And never popular either, Dan. You should not be doing things that are popular. I mean, if you can't be driven by trying to win a popularity contest.
Yeah.
And I definitely experienced that this year. And I've made myself unpopular in a few small circles. But generally speaking, like in the case of our business, 89.6% of all those people who could vote voted in favour of taking our business off the stock exchange. So there's obviously 11% of the people who I am unpopular with, but 89% is not a bad outcome. And so don't try to be Mr. Popular or Mrs. Popular.
And so if you're a business that's struggling at the moment in this environment, you can expect, your prediction is, and it is just a prediction, but your prediction is you can expect that similar environment and potentially even worse with another rate rise over the next 12 months. And so the goal should be to, make the right moves for your business to survive those 12 months and to improve, to then be ready for 2025 to come out swinging. If you are a business going well, then push forwards in those 12 months anyway, because when the economy gets better in 2025, you'll be even more accelerated. Mark, I wanted to ask you now, networking. I mean, I wanted to ask how networking has impacted your I guess your career in business, but in addition to that, it's widely known that Kerry Packer was a great mentor of yours and a business partner and an investor. I'd love to hear what perhaps the greatest lessons you learned from Kerry in terms of growing or driving a successful business.
It's been well documented, but he always was very adamant every 6 or 7 weeks when I met him through the whole period of our partnership, adamant about me reaffirming what it is we do and why, more importantly, why we do it. And it's funny, someone said to me the other day, he's a judge in the federal court. He's a friend of mine. I worked in the law firm with him many years ago. And he said, "Oh, mate, I just bumped into him. I hadn't seen him for a while." And he said, "Oh, mate, I read some stuff that was written about you, blah, blah, blah." I wasn't very, how do you feel about that? And I was thinking about it, and I thought to myself, my objective always, even from the Wizard days, and I worked out how many, and I went back and did this exercise, was to let people borrow money to buy their dream. And that whole purpose discussion, like reminding yourself of why the hell you're doing things, why it is what you do, helps you overcome everything else. So when you're getting tickled up and feeling a bit upset or angry or unfairly dealt with or whatever the case may be, get over it. And what helps you get over it is remembering, why you're doing stuff. And so I got my CFO to do a calculation, and we had to do a little bit of make a few assumptions, but we've lent money to nearly 600,000 Australians over the years to, get their dream. And that's 600,000 out of 3 million. That's not in any one time. That's over a period of time, but it doesn't matter. Because that's 3 million mortgage holders today. So, or nearly 4, but it doesn't matter. But over the time, and that's really reassuring. So Kerry's big thing with me always was every single month when we met, or 5 or 6 weeks when we met, was, "Son, have you and your organisation remembered the reason why you are doing business?" And it's the customer's reason. It's not your reason. You are doing your reason is the customer's reason. It has to be. Sure, we individually want to make money, but it's never what drives the successful outcome of the business is the business's reason. The business's reason has to be the customer's reason. And the customer's reason, even now, and then after all these over 20-odd years being in the same game, I still give myself an uppercut and remind myself of the reason why I do this. And there's no better outcome than helping people get one of those basic ingredients in their life. That's shelter and the feeling of security that they have their own place, or they're don't have to go and rent a joint and stand in a line with everybody else every 6 months or wherever the period is to rent a place and live with uncertainty and insecurity. That's our game, and that's what Kerry kept reminding me of all the time. And I think another one that was really good, really important one too is don't be greedy. If you're trying to raise money or your proposition is put in front of you that you think is okay, but you'd like to get a lot more for it, sometimes that's going to be the only proposition you ever get put in front of you. And he used to take the view, always take the money off the table. No matter what it is, when it's offered, he said, because when you think you might be in a better position to get more money, he said, that's going to be when the money's not going to be on the table. So it's a bit like debt. So if you're in a position, you're doing well, and you think, I don't need to borrow money, well, that's the time you should go and set up a facility, because I'll guarantee, and this is always his view, that when you do need money, you go to borrow the money or try to get a facility, you won't be able to get it. And that's usually because interest rates are high and the banks are sort of pulling back on credit decisions and are nervous about lending money to people in the restaurant game or lending money to people in the IT game, or less, because and that's when the banks take views, because the banks have less money, there is less money supply. Like right now in Australia, there's less money being supplied to the system because of what the RBA is doing. So what the banks can do then is say, oh, shit, we got less money to lend, so therefore we'll be much more scrutinising in terms of which sectors of the market we lend to. And normally those sectors of the market that they won't lend to, or they're scrutinising much more heavily, is probably the market that you could be in. And that's the worst time to try and borrow money. So Kerry's view was, when the money's on the table, take it off the money. It doesn't mean necessarily selling your business. It may be bringing in an investor. It might be just getting a facility set up. But just take the money there and then. You don't have to draw on it. You don't have to spend it, draw it down. You don't have to spend it, but just make sure it's there. That was a really important lesson. And he was a great gambler, like actually, like in real sense, gamble money at the casinos. As soon as he had a really good winning hand, that was it, mate. He walked away. And that's what his phrase meant. If the money's on the table, take it off, which is why he got banned from a lot of casinos around the world. Because he would walk in, and he wasn't a small gambler. Like, he would bet, 5 or 10 million. So, and if there was 15 or 20 million there on the table, he'd just take it away. And the casinos didn't like that. They just wanted you to they wanted you to be a whale, but they wanted you to put it back. And end up in the end, the only casinos he could gamble at in Las Vegas was Steve Wynn casinos. None of the other casinos would admit him because he took too much money out.
How fun. Mark, we're going to switch to Q&A. Because of the time. Now, I've got the questions up on this TV that they put them. I'm just going to go through them, and we'll try to, I guess, answer as succinctly as possible so we can get through as many.
Yeah.
The first one's an interesting one. The question is, how can it be that businesses recording millions in profits while people are struggling instead of lowering prices? How do you think that can be left unchecked? So basically, I guess the question is, do you agree that some businesses are reporting the highest profits in history, for example, maybe banks, while others are struggling? And do you think that should be checked or unchecked?
Well, I'm not a government interventionist fan, so I don't think governments should intervene. In other words, I don't think they should go and tax those entities more, for example, because they're making more money. But where governments could intervene or could participate in terms of policy is to make sure that there is adequate competition in that particular marketplace. So now in Australia, in the banking system, for example, the argument is we should have more banks. In fact, I don't mean neobanks and little banks coming up, because that's just never worked in Australia, but admitting foreign banks in Australia to operate, to take on the big Australian banks. And I like that idea, but equally on the flip side of it, you have a regulatory issue because, the government doesn't want to, but we want a strong banking system. So because, we rely on banking systems. So you'll find that those entities which are doing extraordinarily well, the plus or minus a couple of exceptions, but extraordinarily well, banking, telcos, airlines, etc. The reason why we're not admitting other organisations to come in and to take them on and to take a bit of that profit out and sort of to put more pressure on them in relation to prices is because those industries are fundamental industries which we want to remain strong. We don't want to put at risk. So there's two arguments about protectionism, protecting industries that are fundamental to the way Australia operates, fundamental to our stability. There's that argument. And then the opposite argument to that is, well, if you don't bring in foreigners to take on these particular entities, then the price at which we, the consumers, pay is always going to be too much.
But I've never thought that's. I love that response. I've never thought about it. The more competition, the more the money would be spread, but the better it would be for the consumer. The lower the prices. So less government regulation and normally slowing everything down and screwing everything up, but more business, more competition. And so the next question. What do you think of the local tech startup scene in Australia at the moment? And do you expect it to pick back up much in the next 12 months?
Well, it's interesting. I had a meeting with Tim Fung, who's the co-founder and CEO yesterday of, he was on one of my podcasts yesterday of Airtasker, which is a tech platform. And I guess it depends which tech area you're looking at. But some tech areas are finding it difficult to get the valuations that they were getting 3 years ago. So there's a lot more scrutinization now of the valuation models attached to tech platforms, particularly marketplace tech platforms like Airtasker, for example. And there's a number of them. We know all the various ones. So it's a bit challenging for them at the moment. And Tim openly admits that is the case. But that also means that they've got to start to expand into other territories. But then again, but on the flip side of that, I met up with another guy on one of my podcasts yesterday, who runs this business called AgriWebb, WEBB. His name's Justin Webb, and he's a tech platform for increasing productivity on farms by using data points on a farm to work out for farmers in Australia, but by the way, it's now in 22 countries, exactly when is the right time to take your cattle to market, at what weight, how do you monitor them to be at that particular weight, which ones are doing well, which breeder cow is doing well compared to another breeder cow, which particular area in Australia is doing well compared to another area in Australia. Like using data, it's not one of your typical tech websites, marketplaces, but it's more technology being applied to individual organizations to run a more efficient business and to squeeze every dollar out at the most efficient rate when it comes to feed. And in fact, even this has environmental impacts by allowing certain fields to grow grass when they ordinarily wouldn't, so that the grass can capture the carbon from the atmosphere. So it actually has a lot of applications. And that one's doing very well. So I think, to answer your question, Dan, it depends where the technology, which marketplace the technology's directed to. But definitely anything to do with data, and in fact AI, which is what Justin Webb's business is all about, artificial intelligence and using AI systems to learn about particular farms and then apply that against all farms it's learned against and give you positions. That AI environment re-technology, I think that's firing up pretty hard. But the more traditional technology stuff like marketplaces, that's finding it difficult to get the valuations they're getting 3 years ago.
So perhaps over the next 12 months, some of the best startups to look for would be, or to be in, would be startups that help businesses reduce costs, increase efficiencies, and it just becomes stronger businesses. It will have efficiency or cost, which actually leads kind of to the next question, which is, and I'd be curious what your answer is for this. If you had an idea for a new business that you knew could change the world, what would it be? What sectors could it potentially be in?
Yeah, tech is definitely one of the areas I go for, Dan. Technology, health tech to me is, as the world emerges into bigger middle classes, i.e. India is going to have a middle class by 2045 or something like that of 500 million people. That'll be the world's biggest middle class. There's also got the youngest, the highest growth in young people growing up, as opposed to, say, China's got around the other way, and Japan. So as the world grows middle classes, people become more wealthy. As we become wealthy across the planet, including here in Australia, as we become well wealthy and our population grows, our wealthy population grows, our middle class grows, all of a sudden everybody wants to be doing, those people want to be able to do what everyone else has been doing. So anything that sells something to them is valuable. because they've got more money to buy. One of the things that those classes of people like is that they want to live longer. And Peter Attia has actually tapped into this. So was Hubman and a lot of those other podcasters. They've tapped into this pretty rich vein. That's about how do I live better and longer. And therefore, anything that's health tech that actually allows us to live longer and is reasonably priced, in other words, middle class priced, has the potential to have a global impact, not only in making people live longer and healthier, but also to allow them to spend their hard-earned money that they've now got as a result of being in that middle class, to reward themselves for their hard work and whatever it is that they've achieved. So I think anything to do with health tech that is reasonably priced, perhaps is a wearable, but also has AI attached to it. In other words, then has the ability to tell me over time, for example, or tell Mark Bouris or tell Daniel Hakim, what is a way that Daniel can be more healthy by either through a wearable or supplements or lifestyle or the whole lot, based on what the whole world is doing. In other words, what the software has learned about the rest of the world and then transferred to Daniel. So you might know a doctor who has 50 clients who is learning from those 50 clients what works and what doesn't work. And you might go and see the doctor, and that doctor might say to you, Daniel, this is what my AI in his brain, his artificial intelligence, his intelligence in his brain has machine learned through his brain, what works for those 50 people. Well, I'm just saying, imagine if you could have that through actual machine learning for 100 million people. And then you could somehow apply that to your life and make decisions of Daniel relative to everybody else and actually find specifically what works for me. I think technology in those environments, and that by definition means you need to have a wearable, because you're going to have something that can sort of take your temperature and work out your heartbeat and how well you slept and all that sort of stuff. But actually then perhaps go to the next step and start prescribing things for you that will work for you. That sort of stuff. I love that. I mean, I'm intrigued by
health tech space, and if you can sell it to the Indian market, even better.
But Daniel, you know what? Over time, they will buy it. Because they're going to say, hang on, we've been living in India this whole time. What's happening in America? What's happening in Australia that really helps Australians who have been living these lives, healthy lives, live longer? Because what happens in the first stage of the middle class emerging is they all get very fat and they put a lot of weight on, because all of a sudden they're eating more food, but they're eating the wrong food because they can afford more food. And they don't indulge themselves, but they do things that they haven't ordinarily been able to do. They start, it's typical of all the Europeans who came to Australia in the late 40s. They all died pretty young with a whole lot of diseases like prostate cancer or diabetes or bowel cancer, etc., because they drank beer, ate steak, whereas when they were living in Greece, for example, they were eating vegetables and they never drank much booze, and they were working hard on the farm. So how do we learn from that? How does technology help us learn from that to help those people who are now going into those middle classes, which is my family came to Australia. That's exactly what they went through. And they didn't live longer. They lived better. They thought they were living better, but they weren't living better because they didn't live longer better. That's my whole point.
Mark, we are technically out of time, but I do want to get through 3 more questions that people have either messaged me on Boa about or emailed me. One of them, someone emailed me about hiring salespeople, and they basically asked, do you have any thought or process around how quickly a new salesperson should be delivering? And if so, like kind of how much? Like, for example, at Cub, I actually replied to them at Cub. In their first month, it's literally just training. Second month, they need to get at least 2. Third month, they need to get 4. And then from their 6th month onward, they should be hitting their average KPIs on a monthly basis. Do you have any thoughts around that process and advice?
Well, I would say to that individual, ask Daniel, because Daniel's an expert when it comes to what Cub does. But if I look at my own industry, lending, it takes about 6 months before you start to get revenue. The sales guy starts to get revenue, and the reason why it takes him 6 months before it starts getting revenue is it's about his own confidence in himself as to how the product works. So borrowers are pretty savvy. So the salesperson has to work out, how do I give that borrower confidence that I, the broker, know how to get him or her the best possible rate and the best possible loans the loan under his credit circumstances. And so it's about confidence of the salesperson, and confidence of the salesperson in my industry is about education and examination and putting them through live tests, like dummy tests, like practice tests all the time. So in our game, it's at a minimum 6 months before they start actually selling. Now, that is an industry standard. That is what our whole industry operates off. That's the minimum. Some never make it actually, but yeah. So and then it's about what type of personnel you recruit. So we're very heavy on what type of personnel we recruit. We are looking for people who really want to help someone. They are desperate to help an individual borrow money. They really understand the importance of what that borrower's mission is. And they may well have a backstory. The salesperson may have a backstory as to they might not have been able to borrow in the past. So it's about building an enormous amount of empathy for the borrower. And we've got to actually, in some cases, actually explain that empathy. We tend to recruit now out of banking environments where banks are really good at training people these days too. So as opposed to in the past. So it's where you recruit your salespeople from. So we tend to recruit out of banks. And we find ways to get those individuals. We go out, and it's only happened this year, but we go out and find who the outplacement organisations are for the banks, and we go to those outplacement people and say, we were happy to hold a free seminar for all the people you're placing.
And I think
that's what we do.
Yeah, I think that the summary of that is really look where you can find people that are relevant to your business, but also, and I fully agree with, confidence is key with salespeople. The more confident you can make your salespeople, the more they sell. And then when they start selling, that just snowballs the confidence. And then once they're rolling down the hill, they're on their way. This one's about the start of whether it be Wizard or a business you had before. How long did it take you to actually make any money whatsoever from the business? Or how long did it take you to actually feel like, okay, my business is working?
Well, in the Wizard case, it took about 3-4 years. But after 4 years, we were making like $80 million a year. So we're making a lot of money. But it was a different environment then to, say, the Yellow Brick Road period. Because Yellow Brick Road, we had to suffer a GFC. Then we had to suffer the COVID period. We had to suffer the Royal Commissions and a lot more competition. And so Yellow Brick Roads really just started to make money, like in the last 12 months. We made money, but not a lot of money. So now we're just starting to make money because we had to get through all those periods. So to answer your question, or your audience's question, it depends the industry you're in, but more importantly, it depends what you get confronted with. So, and when have we ever seen so many challenges, external challenges which we don't control and we would never be able to predict? Who could predict the pandemic? Like, it's impossible. Who predicted GFC? Not many people would have predicted the GFC, that's for sure. Who would have predicted a Royal Commission, which is very political? He got politically appointed. So my game is about holding strong during those tough periods. So building a business that can hold itself during those tough periods. And then, as I said earlier, wait for, right now we're going through an interest rate rise period, which is extraordinary, but be ready for when the good times roll. For us, the good times will roll sometime next year, later next year, according to the markets. So I've been the whole time holding my gun, my shots. Like, I've been holding my position, hold. With Wizard, I didn't have to do that. It was a different economic environment. So to answer the question, it takes a while, depending on the circumstances, extraneous circumstances, and depending on what industry you're in. But you must always have your mindset in a position that you can hold until the good times roll.
And my final question, how has networking or relationships helped or improve your journey in business? Or has it?
Well, you've got to have fun. All work and no play makes Johnny a dull boy. And first and foremost, networking, as we call it, or I want to put it a different way, like-minded people is better than networking. Like-minded people, in other words, people who are experiencing the same challenges, but also are looking to have a moment of levity, a moment of fun, a moment of transfer of information. who are open to discussion, those things are invaluable. But like, as I said before, remembering our purpose, that's really important to get us through tough times. But equally, having people you can talk to in tough times is extraordinarily important. But also having people you can talk to during good times, extraordinarily important too, because you want to share. We want to share crappy times. We also want to share good stuff. We don't want to keep it all in our own head. So for me, having networks has been, I couldn't do it without the networks I've had. The fundamental things that are really important to me that have helped me out is having business friends. Is probably a good way of putting it. Not necessarily network. Network can have a bit of a sinister connotation. Sometimes it sounds like I'm trying to get something out of someone. What I'm actually trying to get out of people is business friendship. And in order to do that, you've got to share the friendship back.
Yeah.
And that's really valuable. And building relationships and people you trust and people you can turn to. And just sometimes it's just so important. I mean, I'm lucky. I mean, I know your dad, and I had a business relationship with him. I have a business relationship with you. It's important to me. These moments, the reason I do this sort of stuff is actually keeps me going. It keeps me alive, and I have fun with it, and I enjoy it, and I enjoy sharing stuff with people. Just like I enjoy sharing stuff with you when we meet up, and when you text me, it's fun. Some people think it's a punish, but it's not. For me, it's fun, and it's the lifeblood of me.
And thank you so much, Mark. Guys, we are finished for today, and I just want to thank you all again for being here. What we're trying to build at Boa is really, like what Mark just said, a platform where we as entrepreneurs, business owners can build real relationships with each other, relationships that make us stronger. And that's what we're striving towards, to build the world's best platform for that. And our goal right now is to build the largest, and by doing that, to build the largest network of business owners in Australia through an accessible platform that allows us all to support each other. And at the core of that, it's just like Cub. At the core of that is us, the community, our willingness to collaborate and help each other when possible. And again, I want to extend my gratitude to you all for being part of this journey from the very beginning, for helping us and working with us as we're building our platform and we're learning, what's wanted and needed. I'll owe you all a lot of gratitude for a long time. So thank you all for being here today. And Mark, I always say thank you to you, but thank you for everything you do.
Thanks, brother.
All right. See you guys. Thank you all.
Thank you, guys.